Guys, we are having this special chat today with the fund manager who represents a family office. Family office funds is a new concept which is just taking off last couple of years. They manage large sums, proceeds usually from transactions which have happened at the family level, and now the patriarch or the family wants to take the pool of money thus raised into a compounding machine and want to transform the entire proceeds on the books. So we have with us today Amit Patni, Family Office CIO, Benaifer Malandkar, to discuss her strategy, what she's doing at Patni Family Office, and also her view of the markets, which include the debt market, the equity market, as well as the startup scene. Benaifer, thank you very much for your time.
Thank you for having me.
Benaifer, help us understand first the concept of family office. The market is just getting to terms with this, concept in terms of they're becoming bigger, larger, and a force to reckon with whenever companies are going out and offering stakes or participating in offerings as QIP or other OFS, etc. Even the debt side, they're becoming big, and real estate, of course, they have been traditionally leaned towards. So, how do you see the evolution? You've been at RAAY Investments for almost 8 years now.
So let's start from the source of wealth. Traditionally, there are three main sources of wealth. Data shows that about 42% is from operating businesses, about 30% is from real estate, and the remaining could be from financial instruments. Whichever source of wealth actually culminates into having a sizable portion to manage is when the promoters or the family starts thinking about how to do it best. Most of the businesses that were operating earlier were never being actually, let's say, run to generate a cash value out of them. They were being run to make it into intergenerational transfer of businesses. They could leave legacies as the third and the fourth generation running that business, growing it to the next paradigm of where it had to be. About 8 or 10 years ago, I think what drastically changed in the Indian context was that promoters started to encash and unlock value from their operating businesses. Mm-hmm. I think that was the first or the beginning of the question, how best should I handle my wealth and my family after the operating business has actually been sold off. And that's the creation of some of these offices. Early a very nascent stage, we tried to learn a lot from the West. So once, because if you actually look to the West, you will see that a lot of promoters there have family offices which have been running for the 6th and the 5th generation. And you can name some of the larger fashion retail players. You can name some of the Rockefellers who are very, very popular in starting the concept in US. So we tried to establish what was running in the West and what are the best practices we could get to India. This is how the family office piece in India has evolved since the 2010s. I think what is now rampantly catching up is if you look at another piece of statistics, it shows that most ultra HNIs today in India are actually below the age of 40, and which tells me that about 58% of young Indians are actually in a manner gathering wealth or are encashing wealth to see what is the next line of business. And that's where this whole piece is catching up, where they feel the need while they are on their entrepreneurial journey and managing their wealth, mm-hmm. how could they best manage what they have already encashed.
Mm-hmm. Well, capitalism also in India is just about 2-3 decades old, whereas in the West it's a couple of centuries old. Sure. Probably that also explains, but things are getting very organized at the family office level. At RAAY Investments, can you help us understand what's the broad breakup like? Because as we understand it, the idea here is that one has to compound the wealth over a long period of time on a risk adjusted, very non-volatile manner. So what's your own investment philosophy in general, which you guys all have put together with the family? put into practice here, and if you could help us understand the broad, the way it is structured, what percentages towards what kind of asset class.
All right. So at RAAY, what we have, have a mandate, or what we work towards is a very simple philosophy. We try to work towards capital appreciation for the wealth with a reasonable amount of risk. So this could be reasonable is a very wide term, right? It can be used in a manner appropriate to each family and their risk. But if the underlying risk of any asset class or any product is understood thoroughly and intensely, and then based on that the asset allocation proportion is decided, I think that is the mix that works for us at RAAY. We do it systematically, and I think one other thing which comes to my mind is we have a very strong disciplinarian approach to wealth management. Which means that we follow a certain process, we follow a certain regime, and we we align it in a manner where we feel discipline on, to that extent, even profit booking makes a key difference in how much wealth can appreciate or sustainably over a period of time.
As you were telling earlier, that in a very disciplined manner, every year you would prefer taking some profit off to the table and book it, so that the powder is dry when the opportunity comes. But if one were to talk about 100 units of capital, roughly what is the breakup looking like between real estate, equities, debt and startups?
So whether we like it or we don't, families and wealthy Indians love hard assets. They actually find a lot of comfort and solace in owning real assets. So I would think that generally the proportion of real assets would be about 25 to 30% within a larger scheme of portfolio. The rest would be divided into public markets and private markets. For us, public markets is a mix of equity and debt, and of course all the underlying asset class variants, or rather I should say instruments available in that space. For the private markets, we look at unlisted or early stage ventures, and that combination would be somewhere in the range of 85% public markets and about 10 to 15% of private markets.
So one can understand that equities would be say 40% odd easily at your portfolio level.
So over time, and the strategy for the year determines what percentage of equity actually stays in. But let's put it like that we range between 25 to 35 odd percent.
Okay, so let's start by understanding your take on, because in your previous avatars you've been a debt fund manager, you worked with equity piece in the mutual fund space. Let's start by understanding your call on the markets right now. After looking at a good bout of correction last year, we have just shot back to record levels. One, how are you analyzing the furious rally which you have seen in the markets?
I should say this year has gone by in our fund management life as a very interesting year. It will stay with us all for a long time, especially if you see the rebound which we saw of the last week of March showing 1% today. Mm-hmm. I think that is something which most of us will remember for a while. Having said that, I think markets need to be approached with a lens which is fairly clear of the noise which surrounds it. As I see it for the coming year, of course we are in a year which is election based. So you could actually split the year into two parts, first quarter and the next 3 quarters. For the first quarter, run up to the elections, naturally would see a momentum in the markets to be at where it is, provided the flows that we are seeing currently are actually around and we see those movements happening. In the second half of the year, I would believe, or maybe by July, August, when we see the second quarter results, we would actually see a little fair comparison to where markets really want to be versus where the real valuations are. So I would think that this year requires us to tread very carefully on how equity will play out in the December or March quarter following.
We also observed that the last 6-8 week rally, which has been mainly fueled by foreign investors, has actually come in concentrated towards large caps and within large caps also. Have you seen in your past seen this kind of movement or phenomenon into the market when mid caps have barely caught up but large caps are zooming ahead? And usually when this happens, where does it take us on the markets?
So historically, there are, I mean, you can name 7 stocks in the market which typically get the better part of the FII flows, and that has been something that we've seen over time and again. I think it's got to do a lot with the depth of the market that we have in India, unlike most of the developed markets, which actually are far, far deeper for their commitments. But having said that, I would think that yesterday's mid caps are no longer mid caps over times that we've seen, and we've seen some very brilliant companies come out of very sustainable flows which have been with them. The more patient capital, the more domestic capital which understands their business line and has been supporting their growth in that phase. So I think it's a mix of both, but the broader markets never define where the opportunity lies.
How has your own portfolios done? The mutual fund pieces, the PMS, and even the active stack that you managed in the last 1 year?
So we have been fortunate to have a stable run in a year which has been extremely volatile. I think what we've managed to do is keep our feet on the ground and make sure that we navigate the market and the challenges that came across in the last financial year in a manner where we are not digressing from the core principles on which we built our investment philosophy. So we have not succumbed to deep value buying on certain things which became extremely attractive to look at in that context. But for example, I know autos is a cyclical, it goes through its ups and downs. But at this point in time, if you ask me, is autos a buy or a sell? I would think 3 months maybe it's a sell. But I think for a strategic buyer, it's a buy.
Okay, so you are starting to find value in these.
Exactly. If some, so we look and we are happy with pockets where we fundamentally don't see a change in the rationale with which they're being approached.
So in the same equation, last 6 months when NBFCs went through a very bad patch and some very large ones were being written off with 50% cut in valuations.
That's right.
Did you also took the opportunity to start nibbling in those as the same way as you're talking about autos?
So if you see, if you see data, it will show you that the steepest run up which has happened from Jan till now has happened in the financial services, banking and the PSU space, right? Which means that this entire sector, which actually got so underwritten for maybe a couple of roadblocks that hit their way. Yes, we were meaningfully involved in trying to see whether we could see value in some of them to ride them up.
Consumer is one area which you are also quite bullish on, but within consumer autos we discussed, is it consumer durable, is it leisure travel, is it retail, or it is the good old high valuation, the discretionary one, the FMCG one which you like. What's your take on some of this?
So consumer as a theme at RAAY, we have actually nurtured this theme in a very different manner. We like consumer from a perspective of course the listed markets, and I mentioned auto to you in the bit. But I think we like establishing and nurturing companies which are in the consumer space on the unlisted or maybe the early stage side. So if you see our portfolio, which is quite public to the eye, we have actually tried to find and fund early stage entrepreneurs who have a certain moat established around their businesses. Some which had them when we invested, some which we helped create.
Sure.
So, because our theme is that we are a young population, we now have the facility of most of us having a hand phone, which is a smartphone. And what happens with that, in my view, the first predominant effect is that aspirations grow.
Yeah.
When aspirations grow, the need grows. So there's a difference between a need and a want, right? So we think that if we can ride the aspiration curve of the younger earning generation, which will actually drive this whole consumption thesis. So whether you look at two-wheelers or whether you look at just vehicles in that context, or you would look at something like just the aspiration of wearing a fitted shirt.
Yeah, sure.
Right? I think we are here to capture that move.
Debt is a decent part of your overall portfolio, and you're pretty serious about it, not only because it anchors, but there is a coupon rate which is quite kind of a cash flow generating on an annual basis. What is your view on where rates are actually heading here in India? And for a fairly sized base portfolio like as yourself, do you think 8-9% kind of a coupon rate is a good for a debt, for a debt kind of a portfolio side? Because some NCDs are also offering 12-13-14%, but risk of course comes back on the table in that sense.
So we are in a cycle where things have just changed drastically in the last month. The global Fed and ECBs and giving signals that internationally we are in a more slow growth trajectory, and India will never be left out of that as well. So that clearly tells me that the growth cycle is here to slow, and which will be supported by interest rates being far more affordable than they have been in the recent past. This throws up a very interesting gamut of how debt should be approached in the coming year. Whilst most people would get this at a later end of the curve, I would definitely urge investors to have a fresh look at debt investments. I think they've got into a category where they have become more credit lenders than the traditional debt, and I'm referring to the traditional debt in this context.
So just to come back on the overall portfolio approach, talk to us how the journey has been ever since this place was set up. You've been right from the beginning. So it would have also a lot of ups and downs in the market would have helped you shape your own investing philosophy. So what's a nice, comfortable, targeted and also risk adjusted kind of a compounding rate which you have now arrived upon in the last 7-8 years of the office's existence?
So let me break this into three to give you a perspective of a thought process that we follow. In India, a debt-free, comfortable rate to earn is in the range of 7.5% to 8%, right? If you get your asset allocation right, then on the equity, the listed markets, you could get comfortably between the let's say early teens, right? And then you have a third leg to it where you actually have the unlisted or the let's say the growth drivers.
Where the alpha
Where the growth drivers,
right.
All right. So if you are meaningfully involved and invested into the companies who you are nurturing to become these growth drivers, then over a 5-year period, you could look at a 5x in these companies, right? Based on how you navigate the ecosystem. So if you put all this together, I think sustainably Indian wealth can grow to the tune of about maybe mid-teens or not more than about 16 to 18% on a sustainable basis, conservatively early teens, and best achieved is mid-teens.
Which is good 4.5x in a 10-year period.
That's right.
Right. All right, Benaifer, we'll let you go on that one. Thank you so much for chatting with us, and it was wonderful to get your thoughts on the investing profile.
Pleasure. Thank you.